Good afternoon, everybody, and welcome to the COVID Cancellation Conference, our fourth conference under the title Successful Investing 4. We've entitled this class Appleseed Adventures, and we're very hopeful that we can squeeze in 20 questions, but frankly, I think we're going to be lucky to squeeze in 10, but we'll see. We're going to talk about investing and investment clubs and just have an all-out discussion about those kind of things. We're going to hold any questions from the audience unless they pertain to our discussion until the very end. And I'd like to get going as quickly as possible because we've practiced some of this stuff and we know that it really eats up the time pretty quickly. So let's look at our disclaimer. Real quick disclaimer, we will be talking about real stocks in real time. We're not making any recommendations of any kind. It's up to you to do your homework and make your own decisions about buying, selling, and holding. We might own some of these stocks in our own portfolios, and if we do, we'll try to remember to tell you. If you already received a reminder about this session and about this set of classes in the COVID Cancellation Conference, then you are already on our reminder list. But if you didn't receive something from the Mid-Michigan chapter, then you can send an email to nkavula1, that's my wife, at comcast.net, and she will be glad to add you to our guest list as a reminder of our programs. We run 1 or 2 programs every month, and we'd be glad to have you attend them as one of our guests. If you want a copy of the slides for this particular class, then all you need to do is send an email to Mark R. at manifestinvesting.com, and Mark will have the slides out to you. We will be posting this class and all of the classes from the conference on our YouTube channel. That's the Manifest Investing Roundtable channel, and we will be posting those classes there as soon as they're over. Subscribe to the channel, and then you'll get email reminders about whenever we post something new. Once they're there, of course, you can access them whenever you want and as often as you want. So let's get started with our 20 questions, Mark.
Okay. What I thought we would do is just spend a little bit of a reminder as to some of the heritage of, again, over 8 decades of doing this. And this is kind of where the Appleseed comes from. These are our investment principles, perhaps stated a little bit differently, but I like the way these are stated. This is the foundation for success. And what I thought I would share just for a moment, the 3 gentlemen on the upper right, the guy at the top is George Nicholson. He's regarded as the grandfather of the modern investment club movement. And he was the investment professional that kind of started this all back in the 1940 timeframe. The other 2 gentlemen are Tom O'Hara in the center there, and Ken Janke, the chairman and president, ultimately chairman of the National Association of Investors. And I had the privilege of working with both of them. I never met Mr. Nicholson, but certainly have studied a great deal of his lessons. And you're going to be hearing some of those here today. And I just captured some of the images that I think apply. I think Cy and Ken both agree that the Investor's Manual is pretty powerful. The notion of achieving success on the shoulders of some giants, that they're relatively pretty good secrets in the realm of investing, but wow, you start looking at some of the stuff that they have accomplished and helped us to accomplish, and it's kind of a wonderful thing. And that campfire picture of Snoopy is just that whole notion of all of us gathered, sharing ideas and helping take the mystery out of investing. And probably one of the most powerful images, especially since Hugh McManus shared the story about cavemen and campfires and all that stuff and taking the fear out of investing. So any global thoughts on this, Ken or Cy?
Looks pretty simple and good to me.
All right, so let's go ahead.
I'm ready to forge ahead, Mark, okay?
All right, and forging ahead is important, guys, because like we said, we spent a few times, Ken's talking about 20 questions, and suddenly it was 12, and now I think maybe 5 or 6 is a good target. All right, so let's start with the first question that we got from you guys. What stock have you held the longest? Any lessons or thoughts? I think this is a perfect kickoff for long-term investing Take us away, Si.
All right. You see at the top there, Home Depot. I've actually owned Home Depot, bought it first in 1984 when it was a small company with 4 stores in Atlanta, which were the first 4 stores. I think I bought it when it had 12 stores in 1984 and was, a fairly hot topic the way that you would think of most new companies. I think their initial public offering was in the early 80s, maybe 81, 82. So I was a couple of years behind that. I guess the biggest lesson that I've drawn from Home Depot is patience is important. I bought, like I said, in 1984, bought some Home Depot. I was working as an associate in a law firm when I did that. This is actually about 6 months before I joined NAIC, my first investment club. And one of my senior partners also bought some Home Depot. And come fast forward to 1986 or so, and he's looking at it, and Home Depot selling for about the same thing as when we bought it, which was $15 a share, I think is what I bought it for. And he decided to sell it because he says if nothing happens in 18 months, he gets rid of them. And about 6 months later, Home Depot promptly doubled in price. And Home Depot made a habit of splitting early on. If you knew Home Depot, they would run up from like that $15 level to about 30 or so and would then split and come back down. And they also had a cycle of issuing convertible bonds to fund their growth. And they would then convert those bonds. So that was kind of the cycle that Home Depot did early on. But you could see here that there are times of flatness. Now, some of that early 84, 90, that's just flat because we're so far out, because my original shares that were bought for 15, I think the other day, I didn't bring my notes with me, but I think I figured my basis in those shares are about 70 cents a share.
Wow.
So it's been a company that has made me very happy, and I've bought and sold over the years. Although the one last lesson I will give you, and then I'll hush and turn it over to the other guys, is that, of course, as good companies run and become a larger part of your portfolio, and you question maybe I should sell some because it's a good chunk of my portfolio, or maybe it's getting a little overvalued. What I did, and it's along the lines of what we were talking about with the required minimum distributions, you can donate stocks to charity. And I funded a lot of my church donations over the years with Home Depot. I don't think I ever paid any capital gains tax on Home Depot. So anyway, there you go.
All right. And Ken, you were going to regale.
Well, I have two long-term holdings. Dollar General was the third stock that I ever bought, and it was bought as a mistake. The ticker for Dollar General used to be DOLR, and I'm so old that you used to have to call the broker and spend a lot of money to make a trade. And I called our broker and told the lady that I was speaking to I wanted to buy Dollar General. I'm sorry, I wanted to buy Family Dollar. And she said, that's the ticker DOLR, I think. And I said, I think so too, because I didn't know much better than that. So I ended up buying Dollar General instead of Family Dollar. I never looked back. I've been very happy with it. Just like Home Depot, it split 5 for 4 about every 3 months. It was splitting 5 for 4. So we were building shares. It later changed its ticker to DG. And at one point, it went private. So I had to get rid of all my shares. I made a nice little sum when it went private. And then when it went back on the market again and became a public company again, my wife and I reinvested in Dollar General. We've always been really happy. And I guess the lesson that I learned was that you can find really good investment opportunity in almost any industry that you look at. I guess I never thought about hitting a home run with a discount store, and yet there we are making really nice money with a business model that even my third grade granddaughter can understand. You know, you buy cheap goods and you sell them for a small amount of profit in little stores that are located near little towns all over the country. You don't step on Walmart's toes and you don't step on Target's toes, and yet you just continue to make really nice profits. So there's my story about Dollar General. My other story is about Microsoft. It's now the biggest holding that I have, and I've owned Microsoft since the late 80s. My wife inherited 2 shares of Microsoft that my father-in-law had bought in the late 70s. So those 2 shares have been added to and split and resplit and everything else. And today Microsoft is my largest holding. That's the other side of the spectrum. Sometimes new disruptive ideas are what you need to really boost a portfolio as well.
Yeah, and your metal was tested in Microsoft several times along the way too, but I just find those numbers on the lower right staggering. I mean, the cost basis today on March 13th, according to the Jason Zweig article, 7 cents a share. And you start doing the math, we're talking about a 27%, 27.4% annualized rate of return, you know, since that time frame, and just that number of $100 becoming nearly $500,000. That's just staggering.
Yeah, and I'll just throw in, it would be kind of interesting to put the Microsoft chart against that Home Depot chart, but the big test of the metal in Microsoft too is that you have roughly 95, 98 or so for 10, 15 years of virtually flat, not unlike what you see there for Home Depot in
Absolutely.
the 2000s. And then it has taken off in the last few years as well. I also owned Microsoft and held during that time period. So
we held Microsoft in one of my investment clubs in the late 80s, early and into the 90s, and a lot of debate about whether we should be holding this stock that a lot of folks in the club characterized as dead money. You know, it was just going nowhere. Just you get a dividend from it, a small dividend, and that didn't even start till later. But you had to really be patient with the company. And for our own personal portfolio, we didn't do much selling. We did a lot of holding, and I didn't want to pay any taxes to anybody for anything. So I've changed my mind in that regard in the last 25 years. But in the beginning, we just held on, and it paid off for us.
And I guess I'll use this as my little notation on the power of time. One of the first stocks that we bought in the family investment club in Chicago was Abbott Labs. You know, and Abbott Labs has quite a heritage. It was one of the stocks featured by David L. Babson when he was talking about research into growth investing and that type of stuff. But this kind of dovetails with what we were talking about with required minimum distributions and charitable giving in the green room before the session. There's a story about Grace Groner, who was a administrative staff person at a college in the Abbott Labs, you know, home turf there near Evanston, Illinois, and she had invested less than $200 back when she started as an employee of the company. And in 1990, when she passed away, that $200 investment was worth $7 million. She left that $7 million to Lake Forest College, and you can actually Google that and read the story. It's pretty fascinating when you think about how powerful that is. And we still hold shares of Abbott Labs from over 30 years ago.
As do I, Mark. As do I. I hold Abbott Labs, and we've held it since the late 80s.
And then GE is the other side of the story. That one's been kind of frustrating for about 20 years, but that story is changing fairly dramatically. But in the interest of time, let's go ahead and press on if you guys don't mind.
Sounds good.
Keep on a moving, Mark. Okay.
All right. So you're building a portfolio, again, this is a question coming from an investment club here in Michigan. Do we offer any advice on size diversification, large, medium, and small companies, or industry sector diversification? We're going to talk more about that in a minute. Or does this not matter very much in a modern investment club? So Ken, I'll let you go ahead and spout off on this one.
Well, I'm focusing on a couple sentences from the investor's manual, and you can see the cover of the version that I'm using right there. But the investor's manual contains a paragraph which I just find very powerful. First of all, Nicholson is emphasizing that your 15% target growth of your portfolio is for your portfolio. It's not for each individual stock within the portfolio, it's for the portfolio. And that means some of the stocks will do better, and some of them, if some of them are doing a little bit less, then some of them have to do a little bit better to achieve a 15% average. And that's what he was telling us. We've codified a lot of this philosophy and rules and regulations and everything else, but Nicholson kept it pretty simple. He just said, in order to get to that 15%, you should have sales growth in the whole portfolio as a weighted average of about 10 to 12%. And he said to achieve that, you need large companies that are slower growing and small companies that are faster growing. He didn't set up any amount of sales that you had to have to be classified as small, medium, and large. He didn't even really use the words small, medium, and large as far as how they were going to grow, but rather looked at it, from my mind at least, from the opposite perspective. And he said that you could call it whatever you wanted to call it, but you needed faster growing companies. And you could call the other ones whatever you wanted to call them, but you needed slower growing companies because they were a little bit more stable to balance out the little bit of faster growing companies, which weren't going to continue to grow fast forever. So you put all that together into rules and regulations, and you know, we've said 25% small, 25% medium, 25% large. I like to use the definition that says small companies, faster growing companies for the most part, grow at 12% or better, and slow companies, large companies, grow at 7% or less, and those in between are called medium. I'm not comfortable with the word small, medium, and large, but I'll use them as a real bold generalization to just basically make the point that I want my portfolio to grow at about 10, 11, 12, 12.5%. And if I can boost it to there, then dividends and PE expansion will give me the little bit of extra that I need to go to 15%, which basically, when Nicholson was talking about it, I think he was saying beat the market by about 5 points.
Mm-hmm. Well, it certainly is an area of active debate. That's actually from a Forbes survey of their readers from several years ago. You can actually read more about it at the link down below, and there's a pretty extensive discussion on this subject. So if you feel twisted and torn in all of the different ways that you can think about the size of a company, don't feel like you're alone. Sia, what are your thoughts on this characterization and diversification?
Sorry about that. Clicked the wrong button there for a second. I do not get overly concerned about specific recipes or targets of the 25, 50, 25, but it's clear, as we'll see in the next few slides, that size matters however you measure it. And I think that you need a variety. And again, in my experience, spurred on by your ideas and teaching, Mark, in the early 2000s, is that growth is the best way to measure it, because as Ken just explained, that's really what the whole idea that George Nicholson had in mind when he talked about varying what we now call size was to get varying growth rates, and it only makes sense to me to do it directly.
That kind of
So
leads us into this one. And I've actually injected that box in the center into the slide. Those are George Nicholson's words. All things equal, which again is a kind of an elusive concept sometimes, but over the long term, price appreciation will be proportional to sales growth. I don't know if that hit me quite as much as it did yesterday as we were putting some of this together. And that's pretty powerful stuff. And it's basically telling you what to focus on. And, you know, as we keep track of the mutual funds that do well and exchange traded funds that have high growth rates built into the design of their portfolios, it's really hard to argue with this.
yeah.
And so,
and remember too, we talked about Nicholson, but there's really three major ways that we saw the Forbes chart in the previous slide, but at least in our community, there's kind of three ways of measuring company size. It's the market value, market cap, sales, which is the kind of the better investing methodology, and what we're kind of proposing, none of the above, which would be growth rate. But even when you measure by market value or by sales, your goal is to have varied growth rates. The philosophy is smaller grows faster than larger, larger grows slower but is more consistent, whether you measure it those ways. Problem with market value is that small sometimes means junk in market value. And similarly, sometimes huge market value can still be fast growing. And measured by sales, it depends on what you're selling. There are very large companies in some industries that are only selling, $500 million a year, but they're a large, mature company.
mm-hmm.
So that's the flaw in the sales measure. So why not do it directly and go for growth?
Sure.
I've always been a little bit uncomfortable, Mark, about talking about large companies and saying that they're like the keel of a boat that keeps it steady, that gives it stability and everything. I think another reason to have these large companies in your portfolio is that they tend to be the ones that have the dividend added to them. And that dividend, while a small part of your return, is an important part to go from the 12 and a half that Nicholson talked about to the 15 that he had as a goal.
Yeah, and I think this chart makes a pretty powerful case for, the red line being all of the above investing, the blue line being just the S&P 500, which are going to be your large caps and mega caps, and just look at the difference between the two, and that difference over a long time frame is coming from what we'll call medium and faster growing companies.
Yeah.
All right.
Mark, can you tell the audience what you are graphing when you're graphing that red line?
The red line is the value line arithmetic average. Again, that's equally weighted index put together of roughly the 1,700 companies in the value line standard edition. So it's got, all of the S&P 500 is in there, along with another 1,200 companies that are medium. We would generally classify as medium or smaller companies. Okay. Anything else you want to add to that, or should we press?
I could go on for 30, 40 minutes, Mark, but we better press on.
Well, let's go to another subject that you could take. You could certainly take, and I've heard you do it for an hour. We'd like your elevator speech on your belief that price volatility and risk are not the same thing. And Ken and I will.
I want to jump in right before Cy and say, if you ever get a chance to hear Cy talk about risk in a full class session, please take the opportunity, because it's one of the best classes that I've ever attended with Better Investing. Cy, this is absolutely eye-opening for anybody that's never really thought about it. So go.
All right. Thank you, Mark and Ken, for those kind words. And here's the elevator speech. Volatility and risk aren't the same thing, no matter what Nobel Prize winners and all the pundits tell you. Volatility, very simply, is stock price movement. Prices going up, prices going down. That's all volatility is. Risk can be any number of things, but for long-term investors, I like to think of risk as failure to achieve your goals. And I'm really talking about your life goals that are funded by your financial investment. So it is a financial concept, but failure to achieve your goals, that's risk. Now, volatility and misunderstanding it can impact that, but volatility can be opportunity. Think about all the times that we talk about buying at good values. That's when prices are down. Prices go down because of volatility. That's opportunity. And I'll just mention one other example of where volatility is opportunity and can help you address risk. That is, help you to achieve your goals. Most of you probably heard of dollar cost averaging. We don't have time to go through it now, but take my word for it, dollar cost averaging works best the more volatile the investment that you're dollar cost averaging into.
All right. And for those that want to follow up on and hear the 60-minute version, that is available on YouTube right there. And it's on the page if you just scroll back to October 2017. All right. The audience wants us to define core versus non-core and establish why we should care. Who wants to take this one?
Well, I think it's important to understand that this is coming directly from some of the more sophisticated language that Better Investing was founded on. I know that some of the language became a little bit dumbed down in the 90s when the organization grew by leaps and bounds, and we tried to teach a lot of people in very short time spans what investing was all about. But basically, from the very beginning, Nicholson suggested that 3/4 or so of your portfolio should be in these classic up, straight, and parallel kind of stocks, these classic growth stocks that could provide something stable to base a nest egg on. But he always, from the very beginning, writes about non-traditional investing, and he talks about all kinds of non-traditional investing. And that's sometimes where the if this is a hobby, then that's where the real fun part of the hobby comes in sometimes. That's discovering some of these disruptors and some of these early stage growth companies that are not quite yet profitable, and discovering turnarounds that make you a lot of money. Mark has them listed right there for different reasons. The non-traditional set could even include things like cash or gold, or yes, maybe even cryptocurrency. I know you'd never hear me say that, have you, Mark?
We might have to towel you off.
I'm gonna need a big shower when this is over. Okay.
All right.
But the value of our portfolios, I mean, we're showing our roundtable portfolio split on the bottom right there. And I just don't think this is something new. I think this is something that is for more experienced investors. I think it's something for you to take a look at when your portfolio has reached a certain size. And I think each one of us defines a certain size in a different way. You have to be comfortable before you start doing something like this.
Yeah, and one thing I think I would add to all this is if you Google or search on the Manifest Investing site for the term plungers, that's an accomplished, an awesome investment club out of Bloomfield Hills, Michigan, where they were thinking about disbanding, and rather than disbanding, they reorganized into part of the club following core stocks and the other part of the club doing non-core. It was so cool. I mean, they would even put tape down the middle of the living room or dining room, and the teams would sit on opposite sides of the room. And we have basically done that just to demonstrate what they did. Here's a look at splitting up the roundtable into core versus non-core. And one of the things we have started doing, just because it seems to be making a little bit of sense to us, looking at the universe of stocks that we cover, if you take a look at the financial strength, earnings, stability, and quality, those three factors or characteristics up on the upper right there, if that number adds up to more than 225, you're probably looking at a core holding. I know I sound just like the comedian from Atlanta, right, Jeff?
Jeff Foxworthy.
Jeff Foxworthy.
Yeah.
If your FEQ, is that what it is? Financial strength, EPF FEC, and a Q FEC. If your FEC is greater than 220, you're probably a core.
So what we basically are demonstrating is that there is room in your portfolio for those at the bottom. And the other thing that can be readily demonstrated as companies like Amazon and Universal, and it's certainly not limited to them, the companies will make the leap from down here to up here. As those numbers improve, as the company stabilizes and matures, very often they'll make the leap. Any other comments on that, guys?
Well, and in the eye of the beholder, especially, Mark, I mean, we could sit here and argue probably 4 of those companies on both lists as whether they're on the right list or not. But the point is that if you separate them yourself and know why they're in your portfolio, then I think it gives you a better leg up as to what else you need to put in your portfolio. What else am I looking for once I figure out what I have?
Yeah, and I would just say also, and Ken kind of touched on it when he said know why they're in your portfolio. It might not even be company specific. It could be situation specific. For example, I purchased Citibank and Bank of America both at the bottom of the financial meltdown in 2007 and 8, fully intending to buy them at what I thought was their bottom. It was when the government takeover of Citibank or relief of Citibank was announced, and sell them in probably 6 months. And it was based solely on a market philosophy idea. Just to tell you very quickly what it was with Citibank, and the same basic applied to Bank of America, was the terms of the government subsidy came out. Citibank's price promptly fell on the rumor. About a week later, the rumor was confirmed and it dropped another 50%. I said, wait a minute, nothing's changed other than rumor becoming fact. Surely Citibank is worth more, closer to that rumor number than the other. So, I was purely buying on market psychology. And you can quibble now whether Bank of America, Citibank, or core holdings or not. And maybe even back then they probably weren't, but so.
Yeah, and I think we should, before we move on, and we're about a half hour in, and we're 4 questions in, so we got to pick up the pace. Why should we care? Because you treat them differently. A core holding, you would allow the par or the return forecast to sag much lower, probably approaching 0 or money market rates. For a non-core holding, shorter leash, might be willing to sell it at a market average return forecast or par, and that's you treat them differently because they behave differently. All right, so can we go ahead and press on? This is a subject of great debate. In fact, I think we got about 6 questions along these lines. What do you do with cash as a percent of total assets in clubs or for individuals? Cy, would you like to kick us off on this one?
Spend it? Oh, I guess that's not an option. Generally, and this flows very much out of the risk is not volatility. Volatility is not risk class or session and philosophy. You should pretty much hold 100% of your holdings in stocks, which would be close to 0 in cash. Now, of course, over time, you're going to be selling some of your holdings, and maybe you can't find good replacements immediately. And so you hold your proceeds in cash. That's kind of the investment cash we're talking about. And in my general experience and that of seeing clubs, the market will take care of itself. When the market's kind of high, you're going to have trouble finding immediate good values to invest in. So your cash holdings will go up a little bit. So you don't need to worry a whole lot about it. The big thing that I want to distinguish is the idea of reserves. Depending again on where you are in your life cycle of life for humans, whether you're using your investments, drawing them down, but whatever, you need to sleep at night somewhere probably in the next 12 to potentially as 12 months to potentially as long as 3 to 5 years. If you have income needs during that time, you may not want that money to be in stocks and therefore in cash or some sort of cash in investment. But that's completely different than this idea that you'll hear of asset allocation, which again, I think asset allocation is risky, and that's using the Warren Buffett definition of risk of not knowing what you're doing. So that's again a sales pitch for my full class on risk.
Ken, your thoughts?
Well, I think also I'm in an investment club that had a real big moment after the COVID crisis, and we spent 2 meetings trying to figure out what we did wrong, why we suddenly started losing to the market rather than beating it, and it came down to the fact that we had put together a pretty large amount of cash and became fearful to buy anything with stocks so volatile. I think the lesson that we articulated to each other after it was all over was that it was the time to buy. We should have been holding each other's hands and encouraging ourselves to buy. And instead, we got so caught up in the fact that we had $1 million in the portfolio and didn't want to lose that $1 million that we got fearful of doing anything and missed all kinds of opportunity. So cash can send shivers up and down your spine when there's a lot of it, and that's what happened to one of the clubs that I'm in. The other 2 clubs didn't let that happen. They kept buying and are extremely successful. But the one club got afraid, and they held on to that cash as if it were the last dollars left in the entire world.
Wow.
I think it does.
That's a great sports analogy, Ken. It sounds like that club decided to start playing not to lose rather than playing to win.
Absolutely. Sit on the score. Right.
Yep. I think the biggest consideration, or one of the bigger ones, is the time horizon. Theoretically, a club has a infinite time horizon. Mm-hmm. And Ken actually posted some close to infinity anniversaries last hour. Whereas an individual has definitely time horizons and risk tolerances and all that kind of stuff. So, yeah, Value Line publishes an allocation model that is pictured there in the middle. That's more for an individual. You can see that Tin Cup has been invested that whole time. Then I like to make the point that Chuck Allman, we actually covered this during the Best Small Company presentation. He would carry a heavy amount of the portfolio in cash in his published newsletter, Growth Stock Outlook. But he also had these MOCONs in the portfolio, and he managed to achieve spectacular results, which were very, very low risk, by the way that Wall Street defines it, because he always had so much cash. Good stuff. All right. Next, explain stop loss orders. Should investment clubs use them? And let's let Ken go first on this one.
Well, we're faced with one of Sai's quotes right here, and I agree with him 100%. I personally think that most people don't understand stop loss. I think they think that it means a guaranteed insurance, that if you place a stop loss order, that the stop loss order will trigger when you want it to and as you want it to. And I think that the counsel that I've been giving to my own partners and to myself and my wife in our own portfolios is, if you think it should be sold, sell it. And if you think it should be held, hold it. And let's not get fancy and fool around with stuff that isn't acting the way that we expect it to act in the first place. A lot of people think that if you have $150 stock and it might go down, if you put a stop loss at 130, then it'll sell at 130. Well, they've come to find out that it might sell at 120 or 110 or 100 if the market is really doing odd things. I just am not in favor of them at all.
You want to second that, Si?
Second, you see my quote, and I stand by it. And Ken put a little flesh on those bones. Volatility is not risk; it can be opportunity.
Well, I'm going to dissent just a little bit. I agree with respect to investment clubs. Only meeting once a month, and it can be tough. It can be done. We've demonstrated with Roundtable and various portfolios that it can be quite the challenge. The theory behind a trailing stop limit order is shown there in this graphic right here. And it just means that your sell point follows it up. Anytime you make a new high, your sell point actually follows it up. So from the standpoint of a company that I have the perception and potential belief that it could become a Roman candle. When a Roman candle runs out of fuel, it's not a pretty sight. And I do think that it can be a protective measure in that type of a situation. We talked about doing this. We had sold Apple from the Roundtable tracking portfolio. And in fact, Len Douglas provided this analysis in the forum of, what if you had done it with a trailing stop order? And that one would have worked out pretty well. Again, the sell point follows it up and eventually exited out of that situation. So again, the Roman candle thing is the thing that gets me. I actually used one in the personal portfolio to sell out of Facebook over the last year.
And Mark, I think we're talking about cousins here. We're not talking about exactly the same thing. A plain old stop loss order is a pretty simple transaction.
Mm-hmm.
A trailing stop has a little bit of finesse attached to it.
Mm-hmm.
Right.
I'm still not sold even on a trailing stop, but I think that it gets a little bit closer to doing what it is you're attempting to do when you set a trailing stop.
Yep, I would agree with Ken. I have not used trailing stops personally, but it is the one type of a stop loss order if you're talking about a high momentum driven stock that you're willing to know that you're potentially giving up some potential gain to keep, let's use a gambling analogy now, playing with house money and let the market keep giving you momentum gains. You might convince me that a trailing stop makes sense, but that's a different animal.
Yeah,
well, I'm talking about just saying, gee, I'm buying Microsoft today and I don't want to lose 15%, so I'm going to set a 15% stop loss underneath it.
Oh, I can virtually guarantee if I buy something at 100 and set a stop loss at 90, it's going to be at 90 within the next couple of days.
Yeah.
There's no doubt about it. All right.
The Robertson law, right?
Yeah. All right, let's talk about pursuing opportunity by sector or industry. And Ken, why don't you go ahead and share this one? We actually did this during in fact, the next slide, I think, is our first.
I think the market handles sector diversity, Mark. I've never really watched sectors percentages in any way, shape, or form. I've always been aware from the very beginning that there are a number of defined sectors that don't seem to have a lot of growth in them. And I haven't steered away from those sectors. It's just that it's a very difficult it's a very difficult task to find growth in utilities and in materials. If I could find up straight and parallel in utilities or materials with a high enough growth rate, there'd be nothing stopping me from buying something in those sectors. But I tend to lean to the sectors that you have marked on the investment club sector diversification. I tend to be a little bit heavier in industrials, only because I think my background is with my upbringing and everything favors industrial stocks a little bit more.
Well, that's
I'm
also
not,
that's a Michigan thing too.
yeah, probably.
Guys in Michigan are Tim
Yeah.
Toolman Taylor driven.
Yeah.
So,
But I think basically the market will take care of that thing. The only thing that I tend to watch for when I look at these graphs of sectors is I don't want to see one sector occupying 2/3 or 3/4 of the whole portfolio. And I know that I'm not in danger of that happening personally, but when I visit clubs, that's one of the first things I look for, because unfortunately, I have found clubs where tech stocks are taking up 3/4 of the portfolio, or discretionary stocks are taking up 3/4 of the portfolio. And that, I think, is indicative of not spending enough time outside of your comfort zone. And you got to do that to get a little bit of diversity in the sectors. You got to go where the opportunities are, not where you're comfortable or where you like.
well, I've got nothing to add. Si, any thoughts on your end?
No, nothing. I like Tom O'Hara's quote. I look at it, but don't really let it drive anything. The market, as Ken said, takes care of it. For me, I find opportunities, in various sectors when they're undervalued.
And that rotates around, doesn't it, Si?
Yes, and it rotates around. Exactly.
And sometimes you get a really long period where one sector is really just great investability, and then that shuts off like a spigot, and somewhere else the opportunities are coming now. So
yeah, during our best small company presentation last weekend, Ken and I filled these in as we went along, just for the kicks of doing it. We'd never done anything quite like it, and people actually kind of enjoyed it, where we filed the companies into their sectors and just kind of watched it build out. And I think discretionary is probably not the worst place to be right now based on some of the stuff that we're seeing. All right. Analyst estimates used to form opinions. Which analysts are the estimates averaged together? Are the estimates weighted? I'll answer this on behalf of Manifest Investing, although I think it extends to everything that this community of investors does. We do pay attention to the analyst consensus, not because we believe that they're always right, but by sheer force of the position that they hold in the marketplace, they have a lot of influence. And no, we don't simply average them, and no, they're not simply weighted. It's all part of the analysis that forms the model that is a stock selection guide that takes a look at the business model and files that stuff all in and does the fancy logarithmic graph paper type stuff. But we do factor them all in, and we look at the analysts from Morningstar to Value Line to the old S&P, which is now CFRA, and the analyst consensus stuff that we get from Y charts. And I'm really pleased to see Better Investing has given a lot of those tools to you in the online tools. Your thoughts, Ken?
The only thing that I hear people talking about is an ACE number. And there is an ACE number. There are lots of different ACE numbers. And they don't necessarily agree with each other because they're made up of different groups of analysts. So, that's why we tell people, read a little bit about your company and look at 3 or 4 sources. Don't focus on a single source. That single source is probably going to be right in the middle of the pack 80% of the time, but there are times when that single source is going to be way out there all by themselves, and that's not where you want your analysis to be, way out there.
Mm-hmm.
Yep.
Si?
I don't have a whole lot to add. I tend to look largely at Morningstar Value Line personally, along with Manifest and your bringing the consensus together. One that I would add that if it's available through your broker, I have found beneficial, and that's Argus reports.
Okay.
Because they do provide longer term projections frequently, especially for earnings, but also sometimes for sales. And then to Ken's point of realize there are different ACEs, I just have gravitated over the years toward Finance Yahoo and ACE.
Okay.
There's, as you said, there's a bunch of them.
All right, let's talk about the 4 metrics of quality that appear on when we do a quick analysis guide. Um, Basically, at Manifest Investing, we define quality in the same way that Benjamin Graham did. And in fact, when you look at the writings of George Nicholson, Graham and Nicholson basically named the same 4 things. The only thing that's not on here that was different, and that's because 50 years ago, the world was a different place, and that was dividends. Dividend stability or dividend growth or persistence was one of their 5, and that has changed here over the last 50 years. But we basically take a look at the financial strength, the balance sheet. We do love to point out that Nicholson started that investor's manual with a complete chapter on financial strength in the balance sheet. And we do like to see up, straight, and parallel earning stability. And we do like to compare the growth prospects and the profitability prospects for the company versus peers and competitors. And then the follow-up question to this, we actually penalize companies for in the quality ratings. And I'll let Ken describe where that actually came from.
Well, we were finding that companies were getting high quality ratings that had never experienced any problems of any kind. And that's good if a company goes through their history without experiencing problems. But most companies experience problems when we have an event like we had in 2008 or in 2000 or in 2019 or in 1980. And I can keep listing the events that happen that try a company's soul. And when that's happening and the company comes out the other end, I want to make sure that management has done the right things to keep the company on the profitability track and to make sure that it's going to continue to grow. So when we found a company that has too short a history or that's never been through a significant recession, we say to ourselves that maybe the quality is too high because it really hasn't had any challenges yet, and we give it a penalty. Could the adjustment be wrong? Yes. Could it be improved? Certainly. Is the number right? I don't know, but we're trying to look at what's really happening with real companies and come up with adjustments to make that sort of keeps the quality at a place where it doesn't oversell what the company is doing when it hasn't really shown us that it can move through trying times.
Yeah, I kind of think of this as you find out who's swimming naked when the tide goes out. Sorry, Cy. Forgive me. And the situation was, well, what if the tide's never gone out? You don't know who's swimming naked.
Yeah.
Forgive me, Cy.
I'm keeping my eyes closed and trying not to picture that image, Mark.
All right. Let's launch a little bit of a discussion on selling. This is probably the most popular topic at the National Convention, and there's a number of different presentations that are made, and this specific question was basically asking us about our philosophy, and it itemized what they believed to be a better investing recommendation. And I'll just let Cy, what are your thoughts on this?
On selling? Gee, I don't know. Should we ever sell? I thought we were buy and hold investors. No, seriously, I think that's the first lesson to learn is that selling is not prohibited. And I think that 1 and 5 are the 2 biggest things. And I think that 4 kind of goes in with 1, are the biggest sell points that I look at. If I can improve my portfolio quality or performance projection, ideally both, that's a great reason to sell and replace. And then, of course, if a company has either shown that somehow I misevaluated its quality or its quality is declining, then it's probably time to get rid of it. So But as I think y'all will get into when you go into some of the further slides, the bulk of our selling is normally number one.
Yep. I'm sure Ken would definitely agree with that. Before I turn it over to Ken, we test this stuff on the roundtable tracking portfolio. That's what you see at the bottom. And that's the answer to the question, what if we just simply not done any selling? And you get the buy and forget result there versus what the rate of return on the roundtable tracking portfolio is checking in at about 19%. And you can see the differential. That's not a trivial difference between the two. And so we do think that these type of principles add value to our efforts. Your thoughts, Ken?
Well, around the turn of the century, we got pasted real hard. We, Better Investing, got pasted real hard as buy and forget investors. We're going to buy and hold everything until we die. And we've spent 20 years now trying to move our clubs and our individual members away from the idea that selling is a bad thing. Selling is part of the dynamic ebb and flow of the growth of a portfolio. And in order to keep your sales growth up into that range that's going to give you the kind of returns that can beat the market, you have to sell occasionally to make room for faster growing, better opportunities.
Yep. So we have to be willing to sell. And I'm just going to say that, that notion of a certain number of quarters or whatever, I'm not sure exactly where the genesis of that comes from, but I have a really hard time with recipes when it comes to this kind of stuff. And I'll just leave it at that.
I'll add the word checklists, Mark.
Checklist too. Oh, and here, before we go into the discussion on Iconics, I don't know if you guys were aware of this as fellow Roundtable Knights, but we did have another moment of silence because Iconics is no more. And $3.15 is what they actually would have paid us for it in that situation. The reason I bring it up here is this: I wanted to share with the audience one of those philosophies, again, not cast in stone, but what we believe to be an implementation of the Rule of Five, and that being, in this case, one of the best stock presentations in the history of the Roundtable was presented to the audience. And I mean, this was a flawless, absolutely wonderful, can't miss opportunity back in 2015. And for whatever reason, they didn't follow my instructions. What happened was Iconics brand, actually did a almost instantaneous 20% dip, and we had talked about protective measures. We're missing something here. Let's walk away. So we did. We sold, walked away with $800 of our original $1,000, and the next thing we knew, the thing was basically floating down around zero until it just recently finally ceased to exist at $150 just recently. So this is what we refer to as that Rule of Five type notion of anytime a company falls more than 20% behind the market, it's okay to call a timeout and make a decision to either hold it or sell it. And so that's our moment of silence on Iconics brand. And I just wanted to leave you with this reminder that there are a number of references on better selling that Ken and I have done at other conventions, that sort of thing. You can actually catch them on the Manifest Investing site. And Ken and Si, I think this is what you guys are talking about as far as what should dominate our selling decisions. Any comments? Ken, are you still awake?
I'm still here, Mark. Okay.
I'm awake too. It's not Sunday morning.
All right, so we're within striking distance of getting to 12, so let's go ahead and do that. I did want to point out that Panera Bread is coming back. They're going to come back on the market here fairly soon. Again, more summaries of some of the thought process that goes into implementing those conditions.
I want to just stress one last thing, Mark, before we leave selling. There was the reference to core, non-core return targets that I alluded to briefly. I think it was number 4 on the list that you had. but this improving idea, be careful and notice that it says portfolio. So, if my entire portfolio can give me the return that I seek, even if one of my solid holdings slips below my portfolio return target, doesn't mean that I sell it.
Mm-hmm.
So anyway, let's carry on.
Okay. One of the things that we do provide at Manifest Investing is these things we call chronicles. And it literally is a monthly snapshot of the projected return. That's kind of the Section 5 results shown down there in the red trend line down there, the green price bars, and then the quality EKG up at the top. This is probably the format you're going to see on the company report pages here fairly soon. And just wanted to share that, again, it's like sitting down once a month and taking a snapshot of the study results on a particular company. All right. And let's go ahead and leave with one last question here. This one has to do with results over time. And the questioner is basically itemizing a number of different results. In this case, looking back at different time frames and stuff, so we kind of cleaned it up a little bit. But they were basically challenging the notion or offering the opinion that we were doing two different types of investing. And I don't know, maybe I'm too defensive. My hair kind of goes up on my neck a little bit, but I don't think so. I think we're doing the same thing. We have slightly different nuances. As we make the approach to some of this stuff, we do tend to place a little bit more emphasis on forward-looking projections, but it's the same type of business model-driven analysis. And Nicholson referred to what has erupted out of that 1940 meeting in his office in downtown Detroit as the grand experiment. And that is that all of us can achieve exceptional results, no guarantees, but it is possible to achieve really cool results, focusing in on those key factors that we know are important for any investment. And I just find it kind of fascinating that look at how well all of those pieces, all of those examples are doing versus, the total stock market as measured by the Wilshire 5000 versus the value line arithmetic average you heard us talking about a few minutes ago, versus that average investor as represented by the Dalbar research. So hopefully that's not too much preaching. We do encourage people to think differently, much like Robin Williams from that Dead Poets Society movie. And I'm just excited about how well we see everybody doing. As I look over the results of the contests this afternoon, as Ken and I visit clubs and see the portfolio results, it's pretty cool stuff, and the achievements are really solid. Your thoughts, Ken?
Mark, I would suggest that the BI 100 total return is greatly impacted by a lot of large companies that clubs hold in their portfolios that probably should have been moved out because in order to move the growth of their portfolio closer to that 10, 12, 13% that Nicholson suggested. The BI 100 data is coming from scraping the data from the accounting program that we sponsor through iClub, and we're not scraping who owns it, but the data comes from what do clubs have in their portfolios, and that's how you get what are the widely held stocks for better investing. But I think there's an awful lot of clubs that can use a little bit of dusting and cleaning in their portfolios. They're holding larger stocks. If you look at that list, you probably would ask yourself, why are a few of these stocks still on the most popular 100 list? They're just not growing anymore the way they should be growing. And I would hope that the two of you would agree with that statement.
Well, it's definitely skewed by the large company bias. There's no doubt.
Yeah.
No, absolutely. Although the good lesson to learn from that chart at the bottom is that even the BI 100 with its flaws beats the average investor, and even the value line arithmetic, and depending on your exact time frame, will tend to exceed the Wilshire 5000 as well. But you
40% is nothing to be sneezed at, right?
Exactly. But you've both touched on what I think the biggest difference, if there is, between a manifest approach and a better investing approach. And I think most members of better investing would acknowledge this. The philosophy of better investing when it comes to stock selection is outstanding. The tools are outstanding. Where the better investing tools fall short is in portfolio management.
Absolutely.
And because of that, some of our teaching on portfolio management, to include some of the points that you touched on, weeding out slower growers to get bigger growers, and some of those things are shortchanged. And Manifest has outstanding portfolio management tools based on the same underlying philosophy. So that, to me, is the big. I mean, there's small differences between the two, and where an emphasis or so forth. Maybe, like you said, Mark, maybe a little more on forward thinking and so forth with Manifest. But to me, the biggest difference is portfolio management tools and teaching.
Yeah, Si, with all the emphasis that Nicholson put on a portfolio rather than individual stocks, and time and time again he talks about a portfolio and that attaches numbers to them. We don't even have any tool that measures simple averages from our portfolio as far as sales growth or earnings per share growth or anything like that. And they're absolutely simple calculations to be able to do. We just don't have them in the tools. That's all.
Yep. Funny thing is, they were in I can't recall if they're in the individual investors manual that we've cited today. They probably are, but I know they were in my very first club investors manual. They were called ledger sheets.
Yep, absolutely.
And you did it manually.
Yep.
So why we haven't carried some of that forward with the computerized tools, I don't know.
I remember
well, there was a start made, Si, on the opening pages of Toolkit 6 when that first came out, and there was a lot of data on the opening page, but the data was ignored by most people because it was unfamiliar. They were making an attempt to give us portfolio averages for a lot of stuff,
Correct.
but it just was never being used.
All right, so one last footnote. I will update this for 17 through 21 here shortly. Right now, Tin Cup is running at 22.2% for 5 years, so we're looking at a number up here. That's just fun. That's just fun as in the realm of investing, no doubt about it. All right, so with that, guys, anything else you want to add? Global thoughts?
Well, I just think it's wonderful we got through 12, Mark. Okay.
Yeah, you betcha.
We're just over an hour, so. And we got Jeff Foxworthy into the mix somehow. All right, so with that, Ken and I will be talking about finding and profiting from small companies. We will have some excerpts from our Best Small Company presentation last weekend, but we're also going to be delving into what can we learn from the last several years, looking for some patterns, that sort of stuff. So I'm not sure what we're going to talk about yet, but we will find a way. And tomorrow evening, we'll have the stock panel. That's at 8 o'clock Eastern time. Is that correct, Ken?
That's as if I finish my presentation by that time. Yeah, Mark. Okay.
Hey, I've sent mine to you.
I have yours, Si, and I applaud, and I have Mark's, and I applaud the two of you. But unfortunately, I only have 3, so I'm
taking a cyber bow. And I expect, what did I say? I need sprinkles are for winners. I need
sprinkles are for winners. Okay.
Or maybe it's time for another frame certificate from the Mid-Michigan chapter.
All right. Well, we can do that. I got frames downstairs and certificates. We can do that.
We digress. All right. So with that, I'm going to leave us with a picture of the thing we really like to do and we really miss. And that's you guys. That's a picture from a couple years ago when Ken and I were in Seattle. And it popped up on my Facebook timeline feed today. So I thought we would just reminisce a little bit and look forward to the next time we're able to do that.
Yeah, and I'll just throw out a quick plug for those of you who know anything about the Seattle chapter and events. They are not able to meet in person this year, but they are in process. I think they started it last night. If you go to the Puget Sound chapter on the Better Investing website, you can get the information. They've started their investor education seminar, and I'll go ahead and give a shameless plug for 12 noon Eastern time. I think it's 9 a.m. Pacific time. Somebody named Cy will be talking about portfolio management on Saturday, and they've got some other good sessions. Don't think there's one tonight, but there's one tomorrow and then Saturday, and then I think there's one or two into next week.
Excellent. Closing thoughts, Ken.
I just want to thank both of you so much for helping out on this session. These are always fun, and I hope our audience got something from what we were talking about, and we hope to see a lot of them at our session tomorrow at 2, and then again our session at 8 o'clock tomorrow evening. Those are both Eastern time.
All right, so with that, I'm going to go ahead and close down. Thanks, everybody. Hope you enjoyed it.
All right. Thanks, Mark, Ken, and everybody.